Hello, everybody. I hope all of you can hear me. Okay. My name is Raj, and I'll be doing a presentation today on the deal process that we follow at York Angels. A lot of our angel groups which work with us, they also follow a similar process. And I'll start with the basic overview. Before that, the thing that I would like to highlight is, why is a well-established deal process so important? A deal process which is well-established ensures the success of the angel group as such. A properly developed deal process ensures that good companies are making a presentation in front of the investment group, which in turn ensures that the investment portfolio consists of good companies, thereby increasing the possibility of higher returns, and in the long run ensuring that the angel group is a success as such. If the companies that are presenting to the group are not screened properly to begin with, there would be not properly vetted, and that would result in lower returns and therefore not as much as success as could be possible. This is a full overview of the deal process. A company makes an application which then in turn goes through the pre-screening, followed by the screening meetings, and then through the investment meeting as the one we are having today. At that point, a decision is made whether whether the investing members would be making an investment in the company or not. If it is still a go, the initial sit down with the company is done, at which point a deal lead is identified. This happens along with the preliminary due diligence, at which point again a term sheet is negotiated preliminarily, and if it is still a go ahead, then an in-depth due diligence is done, which is followed by a term sheet finalization, and if it's still agreed upon, then a proper closing. There are 7 questions which need to be looked at each and every step of the investment screening process. These questions I've highlighted here. First of all, the first and the foremost question that needs to be looked at is the deal good for the angel investment group, which encompasses a few highlights, which is like industry, the stage of the product development, group geographic location of the company, the referral sources which have made a reference to the company, and the existing investors. The industry that the company should be working on usually should be a high growth industry with expertise offered by some of the members in the group. Those are the companies which should preferably be looked at. The stage of the product development is essential. If there is a significant intellectual property which may be of interest to the members, or which can be protected, are the companies which should be probably looked at with a keen interest, and more so companies which have already undergone beta trials or have purchase orders or an existing customer base. This ensures that their product has already been validated, and the chances of the success of the company increases. The geographic location of the company. Ideally, most of these companies should be located within 1 to 2 hours of driving distance, which ensures that the investing members can keep in touch face-to-face with the company management and see how the company is growing. Referral sources, which is an important aspect of ensuring what kind of deals come across. If somebody who's already made an investment in a company or has been a good referral source to an angel group, if they make some references about a company being a potential investment opportunity, they should be looked at first. And then again, companies which already have some kind of an existing investor base, it could be friends, family, or through bootstrapping or of their own capital, should be preferred as compared to companies which have not had any kind of investment and pretty much at a pre-revenue or even an idea stage or just a concept over there. The next question that should be important and should be understood well is this the right team? The idea may be good, but is this the right team to ensure that the team will be able to execute the business plan and execute and take it to the next level? For that, we need to ensure that the team consists of not only the domain expertise, but there should be enough knowledge about how to approach the market from the management aspect, and if they need to raise the capital, if they understand the capital markets properly. Companies which are generally a one-man show or family-based businesses are generally to be avoided. The other question that needs to be looked at is, does the business have superior proprietary products? Emphasis on the company who are able to understand their competition and are significantly able to differentiate themselves from their competition should be looked at, and more emphasis should be laid on that. Companies, again, with the high intellectual property, which in turn raises the barriers to entry, should be preferred. Another important aspect which should be looked at over here is sometimes the developers have recently exited their jobs, and they have established a company on similar technological background from the sphere which they came. It should be ensured that their past job opportunities do not interfere with the establishment of their current company, because otherwise there would be a non-competition agreement which may hinder the success of the company. Companies which have the technical ability to develop follow-on products should also be encouraged. Do the products actually address a large market? Basically a market validation, which is very essential for the success of any company. So a good value proposition is very essential. The best way to validate a market is going to the customers and having a paying customer base or a beta users as a reference. And companies which already have existing customer base and beta users are definitely to be encouraged. Market size is again an important thing to be understood and realized, because companies which do have a smaller market size do have a lower potential to grow, and therefore a lower possibility for the investment returns for the members. A company which has identified a niche market has a higher chances of success, because then they are targeting a very specific market with the expertise in that. Their chances of success are higher, and therefore the higher returns. The other question that needs to be understood is the investment that is being made into the company sufficient for them to be able to reach a milestone? When we talk about milestones, it is important that when angel investors are looking at it, they need to ensure that the capital that is being invested in the company, with the investment made, the company is able to reach the next point where it may become lucrative for either the venture investment or that they end up becoming cash flow positive, or at least they are able to raise next round of capital if it be, so that they are able to move on. Companies like this should be again looked at favorably. Overall, has the company made an attractive business model opportunity? Emphasis on companies which have clearly understood their strengths and weaknesses are better off, because they are able to identify what are their strengths, and then they are able to work on those and try to avoid the shortcomings that they have. The most important question is this an attractive business opportunity? What needs to be understood is we need to ensure that we have disconnected our emotions, because some of the business opportunities or the ideas that are being presented may seem to be very interesting, but if it does not satisfy any of the questions that has been answered before, we need to look at it from certain perspectives that it may not be the best valuable investment. At the same time, the reasonable expectation in terms of the valuation is very essential. Companies which generally have a pre-money valuation of over 3 million is not usual in an angel investing world. Best practices indicate that any company which has a pre-money valuation of over $10 million in angel investing should generally be completely rejected. Generally, angel investors end up looking at 5 to 10 times the return within a period of 3 to 7 years, which is essential and which needs to be determined in the initial deal screening process itself. All these things basically need to be evaluated at each and every step right from the time when the company makes an application, to the application review, to the pre-screening, to the screening, and even at the time of the investment meeting. So we need to keep all these questions in mind. diving directly into the entire process now, the entrepreneurs generally make an application through two ways, usually through the GUST platform, which is done through the York Angels website. Online applications provide information on the capital raised, capital required, and the valuation, financial forecast, run rate, burn rate, products and services, target market, customer problems, business model, go-to-market strategy, competitive position, management. Basically, it gives you a complete insight and the executive summary of what the company is doing, how they intend to reach the market, what their current customer base is, if any, if they have, how they foresee themselves, and in terms of the financial forecast and stuff. And that information needs to be provided through the online application. Why York Angel members receive the notifications of whenever an application is made. They do not need to do anything, but some of the members may be interested in reading the companies which have made an application to get themselves accustomed or familiar with the company and before anything goes further. And they may be interested in some of those companies. Upon the receipt of the application, an in-house review of the qualifications of the company is done on the same basis as what we have just reviewed. So the location, the amount of the capital that is being sought, the valuation, stage of the development, whether it's a pre-revenue or a post-revenue product, and the amount of the investment that is being looked at, and if it is suitable for an angel investment. If the company passes the initial qualification, a pre-screening interview is done by our administrative coordinator. Adrian assists with that. We have a pre-screen questionnaire. I think a copy of it has been given in your package. The questions, all these questions are again based on the same lines as the questions that we have covered. So they give a good idea about the same thing, the location of the company, what is the already raised capital, what kind of a capital has the company already raised, what is the pre-money valuation, what is the valuation they are looking at, the kind of products that they tend to come up with, if they already have an existing customer base, what is their exit strategy and stuff like that. If a company is accepted at the pre-screening level, it is sent. It is determined if it will be doing a presentation at the screening meeting. If the company is not accepted, a follow-up call is made and a brief explanation is given. At that time, if the pre-screening in-house, if they determine that the company could probably could benefit from the intervention of the Regional Innovation Center, that is the Venture Lab, further mentoring may be required and the company may be referred to them for further guidance. If the company, however, is accepted, they are scheduled for a screening meeting with a confirmation email, and the screening meeting presentation guidelines are sent to them in that email. The company then proceeds to the screening meeting process. The screening meetings usually occur twice a month at our Insightful Solutions in Markham, which is the head office of York Angels. Usually 2 to 4 companies present to a panel of our members. Rudy, Joss, and Bob Clanfield are the gentlemen. I don't see Bob here. Rudy is here. They are the members who are the primary screening committee members. Any member can attend the investment screening meeting, and it's usually a good experience to understand how the whole process goes about, what kind of questions are a company is asked, and it's a good exercise to be at some of these investment screening meetings. Companies are usually given a 40-minute slot, 20 minutes of presentation followed by 20 minutes of question and answers. Feedback from the screening committee is then relayed back, and a decision is made. Right after the screening presentation, the screening committee discusses among themselves and determine if they will accept the company and if it will proceed to the next level of presenting it to the investment group, or it will be rejected. If the company is accepted, they are sent an email accordingly. If the company is rejected, they may be referred to the Venture Lab depending on if further mentoring and guidance is required, or else they are given an explanation of why they would not be proceeding. A follow-up email, if the company is accepted, is sent along with the presentation guidelines to make a presentation to a group like this. Requests for additional information on the GUS platform is needed and is requested of them. Presenting companies need to complete a form which includes a release form and the presenter non-disclosure agreement, which is to be signed by the company. And a copy of all the material is requested of them on a USB drive. If the company is, if the screening committee feels that the company is too young and they feel that they need to pick up some more traction, they are requested to present again at a later time to the screening committee. And at that time, an investment opportunity may be looked at. Investment meetings occur once a month and are usually held on the last Thursday of every month, except in August. The top 2 or 3 companies from the previous month's screening meetings are invited to present. Companies which are given, each company is given a 40-minute slot, 20 minutes to present, followed by 20 minutes of question and answers. After each presentation, there is a member-only discussion where the group discusses the investment opportunity, share individual domain knowledge and opinions. The group is then canvassed as to the interest level in investing and or request for any additional information. If there is no interest at this point, a follow-up call and a brief explanation is provided to the company. Again, at this point, it may be determined that the company may require some guidance and they may be referred to the venture lab for further mentoring and guidance, or they may be asked to return at a later date to provide an update. If there is a positive interest from a decent sized group, the company is informed of the next steps. The goal is to schedule a face-to-face meeting with the company in the following weeks with a focus on the business due diligence. This is generally done in an informal question and answer session. So by this time, a decision is already made whether the group will be looking at the company for an investment. So the deal screening process by this time comes to an end. At this point, if the group determines that the investment will be made, the next steps, which start with the due diligence and a preliminary due diligence, begins. At the initial, a deal lead is identified at this point from the interested members. There is no formal process which has been established for a closing a deal or choosing a deal lead. This is generally determined by the investor group's domain expertise, experience, and the time available to all the members who may be interested in it. York Angels has recently come up with a deal lead workshop, and we are working towards establishing a certification program for that. Preliminary business due diligence work is conducted by the interested members along with some assistance from Venture Lab if possible. At this point, what the interested group is trying to do is they're trying to vet the company. They're trying to figure out from what they present during the presentation, whatever the company made, that they have an existing client base or a customer base, why those customers have been purchasing the product or the service from the company, what kind of competitors they have. So a basic informal due diligence is being performed. In this, competitive analysis is being done. Understanding of their current customer base is being done. Once the business opportunity has been established and the business issues and the viability of the business model has been understood well, further information may be needed at this point in order to develop a term sheet, and a term sheet finally is developed and a negotiation for the term sheet is begun. A company is given a valuation based on what the investor group thinks, and if this is in line with what the entrepreneurs are expecting, the term sheet, a preliminary term sheet, is signed. The term sheet is negotiated, and this is the process which is ongoing till the time a final term sheet is signed by both the parties. The York Angel standard term sheet is used as a basis of discussion, which generally addresses the following key issues, which include the valuation, warrant coverage, share structure, preferably redeemable convertible preferred shares, board composition and participation, restrictions on management decisions, employment agreements, and non-competition for the key management. The negotiations with the investing company continue until a mutually agreed term sheet is signed or the deal is abandoned. If the deal is being shared with sometimes other angel groups may be interested in the same deal, so York Angels may end up working with the other angel group as a syndicate. If the deal is being shared with other angel groups or the investors, they may be included in this entire process as well. Legal counsel may be brought at this stage if it is necessary, but usually it is left for the later part of the deal negotiation. Deal lead generally leads term sheet negotiation. By this time, the deal lead has already been identified. So he's the person who's usually the one who's leading the whole process for the term sheet negotiation, working with the other interested members and parties. Once the initial term sheet has been finalized, a thorough review is conducted by the help of Venture Lab. All the due diligence materials is acquired from the entrepreneurs and the requesting and the company. Issues such as the legal structure, financial analysis, legal and financial liabilities, capital structure, sales pipeline, customer reference are reviewed and assessed by the due diligence team. A due diligence issues list is shared with the entire investor group, and if necessary, a face-to-face meeting with the entrepreneur is again organized to address all the open issues. In some cases, the outcome of the due diligence meeting may impact the terms of the term sheet and the negotiations may continue. If during the entire due diligence process it is determined that the valuation that the company had initially put or come up with is not right, then the negotiations may lead to the further understanding of the what was the reason behind that valuation. Final investment commitments are then gathered from the York Angel Group and the other angel investor groups if they are involved, and a final term sheet is issued to the company in preparation for the closing. Upon signing of the final term sheet, legal counsel is appointed, and then a term sheet is sent to the lawyer. Legal expenses are paid by the investing company out of the closing proceeds. The deal lead provides a liaison work with the lawyers, members, and entrepreneurs to complete the transaction. The deal lead works with the lawyer to facilitate a preparation of the key legal documentations, including share purchase agreement, subscription agreement, and shareholders agreement. Management employee agreements, including non-compete, non-disclosure, and proprietary right covenants. At the appropriate time, participating members are asked to provide required investor information such as the exact name, address, information, contact information, shareholding entity, etc. Prior to the closing, wire transfer instructions are sent to each participating member. Funds are directly transferred to the York Angels Lawyers Trust account, where they are held in trust pending completion of the transaction. Funds are not released until the deal closes. York Angel Board representatives are appointed at the time of the closing. Board members are usually chosen by the mutual agreement of all the investing members. Director and operations insurance for the director is put in place. Typical involvement is quarterly board meetings and review of the ongoing reporting by the company. Participating members receive the final version of the agreements directly from the lawyer for review and final signatures. After the closing, a final closing package, including the share certificates and all the key agreements, are sent to the participants. So this is the formal deal. This is the entire deal process which is followed at York Angels, and I think pretty much all the other angel groups follow a similar process. Some of the variations may be there at some points, but this is the gist of the entire deal process. Do I have any questions?